Imagine thinking that your business is making less profits, only for KRA to come and confirm to you that you are in fact making more profits. The question is it KRA maths that are not adding up, or it is your own maths? Now, the secret lies in a simple accounting concept referred to as accrual concept. Accrual concept says this, that income should be recognized the moment it is earned, and an expense should be recognized the moment it is incurred. What that means is that when you make a sale, whether you are selling goods or services, and your customer does not pay you until next year, that income, you should recognize it this year. When you are filing for tax returns for the year 2025, you should assume that you are paid, because already you did earn that income. If you incur an expense, for instance, by the end of this year 2025, we assume you will not have paid the rent for October, November, and December for your office. You must assume that you paid that money when you are computing the taxable profit, because as long as that expense was incurred, it doesn't matter when you finally make the payment to your landlord. But the problem we have with many businesses is that they don't recognize the accrual concept. They use the cash basis, that they only record income and recognize income when they finally get the money. And they only recognize expenses when they finally pay for that expense. And this is a very dangerous shortcut that distorts profits, misstates expenses, and at the end of the day, violates the very principle that KRA uses to compute the taxable profits. So when KRA finally comes to your business, they will realize that there are some incomes that you earned but you did not declare, because you are thinking that as long as I have not received that money, it is not income. You will be shocked. KRA will add back that income in the taxable profit, and you will be required to pay more profit. Maybe there are some prepaid expenses that you had for your business before the year ended. For instance, a good example, you pay an insurance cover or a policy for a car that belongs to your company, and you pay it today in November. What that means is that we normally pay insurance covers for a whole year, for 12 months. So it will run from November 2025 to November 2026. And assuming you are paying for 120,000. Now, you are only supposed to recognize an expense of that insurance for that relates to the current year. So we are saying about 12 months. How many months do you have to the end of this year? That is November and December. So if you paid 120,000, basically 10,000 per month, you will only recognize an expense of 20,000 from that insurance cost that you have incurred. The other 100,000, you should recognize it and claim it when you are filing returns for the year 2026. So if you had done that, what KRA will do, it will disallow that expense. And when an expense is disallowed, what happens is that you pay more taxes. And as long as KRA notes there is a gap somewhere, they will issue you with an additional tax assessment. And what they will do at the end of the day, impose more taxes on you, penalties, fines, and interest. Why? Because of the timing error. Now, what is the solution? Before you file that next tax return, ask yourself, are my profits based on cash or on reality? Did I use accrual concept or did I use cash concept? Now, always ensure that you train your accountants, the people who are doing the bookkeeping for you, to use accrual system, and to always ensure that they reconcile income and expenses to their actual accounting periods. And finally, always ensure that you close all the loopholes in your books before KRA does open your books. Because with time, you will realize that accounting concepts, they are not suggestions. but they are your shield to avoiding KRA tax surprises. Always use accounting principles and more so the accrual concept. Be proactive, be compliant, and move your business to the next level.